Hello everybody, welcome again to Future Finance KHF. Today we're gonna do a revision of what we've talked about in the last few videos. The importance of this revision is because we need to stay on the same track, me and my viewers who are interested in adopting this method, this approach of stock trading and how to build a boundaries strategy in order for you to be successful in stock trading. I wrote a sentence that is really important and it has a lot of meaning. It says stock trading is on the edge of being gambling or real investment. So we want it to be a real investment, not gambling, and that's why we're doing all these efforts. So let's move quick to the subject. So we said that in stock trading there is a risk. In everything in life there is a risk in general, but here we're talking about stock trading. The risk in this type of business is something that you cannot take out of this equation. So it's the only thing that you have to keep in your mind, because the risk meaning losing your money. So if you are a small investor, you're starting with a little bit of money. If you don't know anything about what you're doing, if you know a little bit of what you're doing, so the risk is really high to lose that little bit of money that you started with and you were hoping, or you had some high expectations. So in order for you to really achieve your goal and be successful, you need to understand what the risk means in this type of business. So what it means, the risk means that there is no way to take it out of the equation. It's always there. It's gonna be there every time you buy a stock. So since you cannot take it out of the equation, you can only do one thing, and that is managing the risk. How do you manage it? So in order for you to manage the risk, again, as a small investor and as a beginner, as a starter, you need to set some boundaries for yourself, and you need to stick to these boundaries in order for you to protect yourself and achieve your goals little by little. And once you are an advanced investor, you already mastered all these techniques, you mastered the concept, you mastered the strategies, and you were able to build now your own strategy, then that's a different story. Go and do this stock trading the way you want. But if you are a starter, you're looking for ways to get some help to understand the stock trading and start this business, then listen to this. If you are convinced, go ahead and do it. If you're not convinced, just move on and find another place to be taught how to start this type of business. So these boundaries that we need to set consist of four important things: the amount of money you are investing, the stock price that you're paying for, are you a short-term investor or a long-term investor, and there is a promise that you need to make. So these four elements is the boundaries that you need to set to yourself. So of course, the first one, the amount invested. So if you have $20,000 and you're trying to invest in the stock trading, and if you don't know anything, then the risk is super high than if you are investing $2,000, because you're not risking all your money. So it's very important to know how much money I need to invest. Since we are talking about beginners, about starter, we're talking about managing the risk. We suggest that you invest only $2,000. Why? Because $2,000 can do a lot for you. So if you only have $2,000, that's money that you save, that's money that you are willing to sacrifice. You're not taking it away from any other priorities in life. So if it's money that you're willing to try, if you can succeed in this type of business, go ahead and start, open an account, put in $2,000 and start learning about stock trading in this channel, where we are trying to teach you and introduce to you a method and approach that I think personally it is a successful way of starting stock trading, because it's provable, and I have used it, and I have been through a lot up and down until I found myself doing this stuff that I'm introducing to you right now. So start with $2,000. With $2,000, you can do a lot. The second thing, invest in less than $2 stock price. So we answered the amount financed, the amount invested. We said $2,000. So even if you have $20,000, try start with $2,000. So if you have only $2,000, also start with $2,000. All what matters is that it has to be an amount that you can sacrifice. That's all you're gonna lose if you lost, and if you win, then you're gonna build on it, and hopefully you'll win, because that's what we're trying to do here, trying to teach you how to manage the risk in order for you to be able to be profitable and successful in stock trading. So buy a stock under $2, because there are a lot of profitable ones that they have the potential to go up a lot, and they can be below $2. They can be undervalued stock, underpriced, or they can be, for one reason or another, they fall down, and now it's time for them to go up. So we're gonna go ahead and study these stocks, but that is a suggestion. With $2,000, you can buy any stock less than $2. You can buy 1,000 shares, because the minimum you need to make money is 1,000 shares in order for you to make $10 on each cent up. So if you have a stock that costs you, it's priced at $1, it costs you $1,000. When it goes up from $1 to $1.10, then you made $100. Okay, so you need to be able to buy 1,000 shares at least. That's why you will invest less in stocks that priced at less than $2. That doesn't mean that when you have $10,000 in the future, you're gonna invest in a stock that over $2, $3, or $4 stocks, because then you're gonna be leaving these boundaries that you set up for yourself in order for you to be successful, and go into a different stage that might be super risky and make you lose all your money if you don't find other boundaries to be able to protect you from the risk that became higher when you invested in higher priced stocks. So now we said the amount invested, the stock price. Also be short-term investor. Why be short-term investor? Because you can make quick money, and you can get out of these stocks before it falls. Meaning these stocks can be good for a month, for two, for a year, but maybe for 4, 5, 6 years, or for 3 years, or 2 years, or 1 year. If you go long term, it might not be as good as it is for a short time. And normally when people invest on a high price stock, they go for long term. They invest a lot of money because it brings them a lot of profit on long term, and they live off dividends. So they make money also by getting dividend from investing $100,000, $1 million, $2 million, or whatever amount they are investing in that company. But this type of investment, first of all, it needs a lot of capital, it needs a lot of money. If you have a little bit of money, then you cannot get any benefits if you can buy 1,000 shares. Plus, if you are a short-term investor and invest in these stocks, they can fall down so quickly, and you can lose $10,000, $20,000, $30,000 if you sell them. So you'd better, when you are investing in a high-priced stocks, you have to go long-term in order to protect your investment. If you are being a short-term investor and invest in those type of stocks, then you are taking so much risk, because there is nothing you can do to protect yourself from losing value for any reason. Those stocks, they can fall down 50%, 30%, and you end up losing a lot of money. The fourth element in this equation is make a promise. What is make a promise? Make a promise meaning that if you lose these $2,000 that you start with, you're not gonna invest again. The reason why you're making that promise, because you gotta put on your shoulders some kind of responsibility to make you be super careful when you choose which stock you have to buy, because sometimes when you get excited about some opportunities, you might trick yourself and you see that there is an opportunity over there, but your mind is telling you no, that's not an opportunity, but you insist just because you're seeing how it's jumping up and down and all that. So you end up losing your money because you're not thinking of the consequences of losing that $2,000. You are an investor with a small budget. If you lose it, that's the end of it. You're not going to be investing again. If you say this to yourself, you're going to think twice or 10 times before you make a decision about which stock you're going to invest in. So these are the four boundaries that you need to keep in mind, and you need to start your stock trading based on these boundaries, and from that you move to how you build a strategy. So the strategy has 3 phases. The first phase you're gonna set your goals. So this strategy has 3 phases. The first phase is setting your goals. What are the goals that you're gonna be setting? The first goal is to do 500 a day. Your daily goal is to try to make 500 a day. Also, in order for you to do that, you need to buy one stock at a time. So with a small budget, don't buy more than one stock at a time. Don't put all don't put all your eggs in one basket. That's how they say it. So if you have a $2,000, you don't buy a stock that costs $2, because that's mean you're spending all your money. If this stock collapses for one reason or another, you lost all your $2,000. So try to pick stocks at $1, less than $1, between $1 and $1.50, so at least you have something left if anything to happen. Now with this approach, you're not gonna have situations when you wake up and you find the stock that vanished. That is when you get to know how to read their financial statement, you'll be able to answer the question, the ongoing concern question. So if this stock is good enough to be there tomorrow or after a while or not. Normally when you do a long-term investment, the ongoing concern, meaning that this stock is going to be in business, this company, this firm is going to be in business for a long time, and it's not going to vanish, it's not going to disappear the next day, or it's going to be halted from trading by the SEC the second day because of one reason or another. So that's what we try to find out here. So we're going to be answering that question of ongoing concern when we start actually looking at stocks and trying to do some research and see if this company is going to be good enough for us to invest in it, at least for a short time. So the daily goal is $500. That is a reasonable goal. You make $10,000 a month if you achieve this goal 100% of the time. If you achieve it 50% of the time, you're gonna be able to make $5,000, and that's not a little money. Also, that is a good money, and you build on it until you achieve the second goal, which is $10,000. When you have $10,000 in your account, you will be able to invest in multiple stocks at a time, multiple stocks. So you can invest in 2, 3 stocks, because you can pick stock that costs $1, another one maybe costs $2. Another one maybe costs $1.50, another one maybe costs 50 cents. Just don't exceed the $6,000. Just leave $4,000 at least. When you have $10,000, invest in stocks that will not cost more than $6,000. So you're not gonna put all your money in one basket. Don't buy one stock that costs $6,000, because you're not buying a stock that costs $6 per share. So don't do that, because that means you're risking, you're forgetting about the risk factor. All you're trying to do all the time, anytime you buy stock, anytime you think about buying stocks, you're gonna have the risk factor in your mind. You're gonna have the risk that you cannot cancel, that you cannot take out of the equation, that you have to manage it. And that's how you protect yourself. And also you're gonna keep in your mind the promise that you made, because if you lose your money, you're out of the game. The final goal that you're gonna achieve is to be able to accumulate in your account, in your brokerage account, 25 to 30 grand. In this case, when you have more than $25,000, when you have $25,000 in your account, that means you can do as many trades a day as you want. So you can buy a stock, sell it, buy another stock, and sell it, buy a third, fourth, fifth, sixth, 10 stocks, and sell them the same day without any problem. If you have less than $25,000, you can only buy 3 times a day. So if you use all these 3 times today, and you buy, you sell, you buy, you sell, you buy, you sell, that means you're gonna wait 5 business days to get those 3 attempts back. So that will actually raise the risk factor, because if you buy something and collapse, you won't be able to sell it. If you sell it, they will ask you to deposit like $25,000, or you're gonna be suspended for 90 days. So sometimes if you get in these situations, you have no other solution, you don't want to lose money, you lose your money, then just sell it and be suspended 90 days, better than losing your money. But that's part of the game, that you need to manage that risk that way. Don't use all the 3 attempts in one day. Also, when you get $25,000 in your account, if you get $50,000, take it. We want to take $20,000 and leave at least 30 grand in there, so you can have that much money that will allow you to sell and buy as many times as you want the same day, and that will actually help you to manage the risk better and reduce its consequences on your daily trading. Okay, so that was in phase 1. We set the goals. The phase 2 of this strategy is to build your book of business. What is your book of business? It's all these stocks that you have on your watch list. So you go to finviz.com, you collect all these stocks that we said is being sorted by dollar, so it means anything below $2, and also by volume. So basically, I'm gonna put it right here. So on finviz.com, you're going there, you're picking your stocks from there. You go by less than $2, right? Less than $2 stocks, less than $2. And also you have to have, they have to have like an average volume 1 million. So you're looking at stocks that have average volume 1 million trades. So that's how you sort your search. So that's how you build your book of business. So you collect all these stocks that fall in this category, and you put them on your watch list. You can create this watch list on an Excel sheet if you know how to use Excel, or you can create it in your brokerage account. So you can just create multiple watch lists, because you have to have stocks that you think they are priorities for you. You think they're gonna go up in a short time. Some other stocks, they're moving, but you're keeping your eye on it. And some other stocks you think they're good, but they are very slow, and they can be a good investment in the future. So you keep your eye on them too. You wanna invest your money with the ones that they will make money for you in a short time. So, but you keep your eye on the ones that are good, stable, strong financially, and they have the potential to go up. But you're just watching them because the way they behave, they're slow, they're not volatile. So you collected all this stock. The second thing you do, you investigate and you rate them. And rate them meaning that's when you create your watch list. So from 1 to 10, you say, okay, this is 9, this is 10, meaning that's so strong, so good, an exciting opportunity. You make one list for all these stocks. And then another one you say, no, it's medium, it's moving, it's this, it's that. You make another list for this type of stocks as well. So here I'm gonna put it, make multiple multiple watch list. Okay, that's how you rate them. So whenever you go to your account, you know, okay, I gotta keep my eye on those, so now I can make money, this is moving, this is good, this is my priority. And that's how in the future, when you'll be able to become familiar with these stocks, you will know how they behave. They will have some kind of habits, how they go up and down based on whatever going on in their business, because you become familiar with their business, you become familiar with their events, with what type of business they do, and all that kind of stuff. And also you'll be able to eliminate the bad stocks. So if you have suspicions about one stock, you think it's bad, so but you are a little confused about it, you think there might be an opportunity over there, so you can make one list for this type of stocks. But always, if you think of a stock that is really bad, just eliminate it from your mind, because you don't want to go into risky ones. Phase 3 is the in and out strategy. The in and out strategy, because you are a short-term investor, you're trying to buy something that you are expecting to make money out of it in a day, 2 weeks, or something like that. So that is the in and out strategy. So you're learning how to use the stop loss on quote. There is a tool in your brokerage account, there is a tool. It shows you how to stop loss when the stock goes up. You bought it at $1, went up to $3. You can set it up at $2.50. Stop loss on quote, it's called. You set up at $2.50. If it falls to $2.50, it's going to be sold. If it keeps playing between $2.50 and $3, then you are on a safe side. And if it keep going up later, then that means you're trying to make the best out of this stock to make the best money you can. And that's when you use your stop loss, because you want to make sure that you're protecting the profits that you make, but at the same time you don't want to miss the opportunity if this stock has the potential to go up a lot higher. So you leave a little room, a range for this stock to play with, in order for you to make sure that it's going up or it's coming down. If it comes down, it's going to be sold and you'll be able to collect your profits. So search, research, then invest. So basically that's all you do whenever you look or think of buying a stock. You have to do your search. You did your search, you have now your watch list, and then you decide to do another search to make your watch list bigger. And then once you do a search and you collect more stocks, you're gonna do a research. So you're gonna read about them, you're gonna see what they do, you're gonna see what their 50 weeks price. That is a very important indication of if this stock is if it's a stock that it's worth your time to look further in it or not. And also you look at their volume, and after that, if it's worth your time, then you look at their financial statements, you look at the graph, you see how they're behaving, what was their 5 days, to make it simple, what was their 5 days on the graph, to see just how volatile they are, what was a month before, 6 months, a year, and so on. So, and then you decide to invest in it if you think that this is really a good opportunity and you need to jump in. Now there are things that you need to learn later, is when is the best time to buy and what price. How do you decide what is the best price, or when do you really buy the stock and when do you need to sell it? We'll talk about that in other videos. So right now we're gonna just try to kind of just pick a stock and see if we can exercise some of the things that we learned in here. So we're gonna go again to finviz.com. Okay, on finviz.com, because a lot of people maybe they don't know this website, so they need to get familiar with it. It's a website that I use personally, and I find it very useful. It has everything that I'll be looking for, so I advise you guys to use it. If you have another website that you can find this stocks on, so do whatever you like. But on this one, it's a very good website. So here in the middle, there is this row right here in black. or in gray, darker gray. So you have the screener right here. When you open it, finviz.com, you'll see this page. So you go to this row and you click on screener. Now you have all this stocks that is listed, code, company name, sector, industry, and so on. So what are we interested in? We said we need stocks that fall below $2. So on the far right side here, there is a price. Any, you click on any, you see under $2. You click on $2, now everything is listed under $2. Also, we said we need stocks that are active, meaning they have a good volume. So if they have 1 million and above, they are very active. So we go to the volume on the far right as well, right here, and we click like this. It will list from low to high. Then we click it again, it will list from high to low. So you have all this stock listed. In the bottom you'll see that there is tens of pages, at least 14 pages and more. All these are stocks below $2. So we're gonna find the one that we can be interested in. So normally you have to create your watch list. If you have an Excel sheet, it's very easy. What you can do, you can just copy this whole thing and then paste it. I'm working from iPad, and from my iPad I can't do this on an Excel sheet, but in the future I'm gonna show you guys how to do it. But not everybody knows how to use an Excel sheet. That's why you can create your watch list in your account, and put these stocks that you think they're good. So let's say right now this one is called SNDL, Sundial Growers. It has 400 million trade volume. That's the last time that been traded, the last business day, which is last Friday. So what can we know about this one? So let's say we don't need to click on it. Let's just try to investigate, see if this stock is a good stock, why there are so much on it. If a big volume doesn't mean this stock is a good stock, it just means it's active. There are people that buy this stock to short sell it, so they pump the dump, like they say, pump the stock to dump it. And there are people that they have anticipation that this stock is gonna fall because they're playing options, and that's why the volume keep growing. And there are people also, other investors, that might think that the stock is gonna do well. So let's see if this stock is gonna be good or not. SNDL, let's put it right here. So you go to marketwatch.com, that's the other website that I use. On the far right in the top, you'll see here the little one right here. You put SNDL. Let's do the search, SNDL, and you put search. So now we have it right here. So right now SNDL last day was traded, which is the last Friday. It was 64 cents. It closed at, it fell actually 6 cents. So I think it closed at 72 cents. So it closed at 72 right here. You see it open at 74, closed at day range 70 to 78. It's not showing the price. They should put the price that it closed, but it is 72 cents since it fell 6 cents and became, it's 70 cents. Sorry, 70 cents. 6 cents to 64. That's 70 cents. So day range 70 to 78. Closed at 70. Okay, so the volume, it's a high volume, 299 million, 295 million, that's a lot. And also the 50-week range. So normally, for me as experienced stock trader, when I look at a 52-week range, it either will get me a cold feet, or it will say, okay, there might be an opportunity over there. So if I see this stock 13 cents and it was 52 weeks within a year, it was 388. That's fine for me, because it right now it's at 64 cents, so it might go $1.50 based on what's going on with the other things that we're gonna be looking at. So, but just looking at this fact, if it was the highest $1, I will guarantee to you, if it was the highest within 52 weeks, $1, and the lowest 13 cents, I will just skip it. That's it. It's end of story for me. If you wanna bother yourself, waste your time, you can do that. Look at financial statements, see that, oh yeah, they have a good financial statement. You can keep it on the cold watch list. You know, if you like everything else, but the price was super low within a year, then you can keep it on a cold watch list and just keep looking at it. But for me, I will just skip it. So anyway, So once you look at 388, that's good. That's not bad. The price range is good. Is promising. Maybe there is a place where it can go up. It's now right now it's still under $1, which is good. So the second thing you want to look at, click up on profile just to read about it, to know what kind of business they do. So you look here, and so when you become familiar with this stuff, you'll be able to have some expectations. So those people, they engaged in the production and distribution of flower, pre-rolls, and vapes. It operates through the following segment: cannabis, ornamental flower, and corporate, and so on. So they keep talking about this stuff. So you read this, and it's sometimes important to know what year was the company was founded. Here they don't put the year, they just put who found this company, and they put the where in Canada. It's a Canadian company, but of course it's registered in the American stock and in the stock market in the U.S. So it's traded in the stock market in the U.S. So the financial statements right here, you look at on the financial statement, and you try to see, okay, what's going on? Why this high volume? Why the price is low, and so on. So you ask yourself all these questions. So here on the financial statement, there is only two things we're gonna look at: the income statement and the balance sheet. That's all you need from the financial statements, in my opinion. At this moment, you really don't need much. Don't make it too complicated. Those two things, they will tell you if this stock is good to invest in it or not, or if you have to keep it on your watch list. So sales revenue in this stock, here it shows historically 2017, 18, 19, 57 million. Before they had nothing. In 2019, they had 57 million revenues. Okay, that's a good number. Let's see their net income, which you see it in the middle of the page. Historically, like in the last few years. So in 2017, they had 1.1 million and change in loss. Second year, 52 million in loss. The third year, 2019, 204 million in loss. So that means every year consists of 4 quarters. They had at least 50 million on average in loss every quarter. Okay, so if you look at the quarterly, let's look at the quarterly, because that's the other important way of looking at the income statement and balance sheet. So if you look at the income statement, the sales revenue quarterly right here, we're seeing 25 million in the last 2 quarters of 2019. They have 25 and 16 million. We knew before that they had 56 million the whole year. So now they don't list the ones before, they list the last 2 quarters, and then they list the next 3 quarters of that year, or the next 4 quarters if the last quarter has been reported already. So they have here 25, 16. Then in March, the first quarter of 2020, they went up 1 million, then they went down to 14, then they went down to 9 million. So the trend on the income statement is down. And on income statement, the revenues it adds up. So that means in 2020, this plus the 17 plus the 14 plus the 9 plus whatever is going to be reported for the last quarter, that makes the whole revenue of the year. Now you'll see on the balance sheet it's a little bit different, and I'll show you what I mean by that later. So if you look at, so we know now the revenues are falling. In the net income by quarter is the first 2, they were 73 and 109 million loss. That means 109 plus the 73 plus whatever they had lost in the first 2. We said on average they lost 50 million. So if they lost here 180 million, so they lost almost 200 million here. They're losing, so they're losing in the other two little bit less, because their total loss in 2019 was 200 million. So they have on the last 2 quarters only about 170, 181. So the first 2 quarters they lost about 18 million in the first 2 quarters of 2019. But that's a lot of loss because they're not making that much money. Also, the 2020 they started with 32 million loss, 22 million loss, 53 million loss. So it went actually down in the second quarter, and then it went up 20 million or 30 million. And the last quarter reported, most likely they're gonna have a loss too, and that's already 50 and 30. That's already 100 million and change in loss. So they're not in a better position, but they might actually have a less loss than 2019. They might have about, because right now the average is changing, they might have another 50 million in loss, so they'll end up with 150 million. That less than last year, but that's not good because their revenues are falling as well. So far this company sucks. It's really not a great opportunity, but let's see what's balance sheet is saying. So on the balance sheet there is like probably about 5 or 6 things that you need to look at. The first one you need to look at in the assets part. The assets part is what the company owns, what the company owns in cash and fixed assets and all that. So their cash and short-term investment, historically in 2017, 18, 19, they were 2 million, 10 million, 47 million went up in 2019. That's not a bad number. But compared to their revenues and loss, it is a bad number. But right now we want to see how much in assets they have. So that's cash and short-term investment. They still have other things like account receivable and all that. But we want to look at this, at the cash. We want to look at the current assets and total assets. That's all what we were going to look at from this first part of the balance sheet. So on the assets, we're going to look at 3 things: cash and short-term investment, current assets, and total assets. So historically we saw what are the numbers look like. So let's click on quarterly, because that's what's important to us. Quarterly, so here we have these numbers. So the number that you see here in the last quarter of 2019, that's the total assets they have for the whole year. That's not added to the one before. They had before 114 million, but they dropped to 47 million. That means they lost value. Okay, so in 2020 they started actually with less. So from 47 they lost to 18, and then the second quarter 19, the third quarter 19, they stayed the same. So that's what they had in cash and short-term investments. So they had so much money in September of 2019, 114. Now they have in the same month, the same quarter of the 2020, 19 million. That's a drop of what? That's a drop of like more than five times. That's a 20% or less than 20%, 18 or 15% of what they had in the same quarter of last year. So that's a disaster for them. Also, you look at you look at their current assets just to see, because the current asset includes their short investment, cash, and other type of current assets. It includes everything, and that's really the important one that we're looking at, because if you have more current assets than their current debt, that means they still can function for a little bit, and here where you can answer the questions of the ongoing concern. But if they have less, if their current debt more than their current assets, then they're gonna be in a bad position. That means they are going through a very hardship, super hardship, and they are under the risk, and they might not be able to satisfy their short-term debt. That is a big financial distress, and they could either be filing bankruptcy, or they need to be restructuring their debt. So if we're looking at this one, they had in the last 2 quarters of 2019, they had 173 million, then they dropped to 133 million. That's everything they had. They owned as assets, in current assets, 133 million. 2020, they dropped to 101, 73. They ended up, the last quarter report is 65 million. So that's all they have, 65 million in current assets. So you can keep that in mind, or write it on the side, or you're gonna go back to it when you compare it to their current liability. So 65 million in current assets, that's all they have in the last quarter reported, and most likely it's going to drop in the next quarter. It's going to drop, and that's not going to be a good thing for this stock. So you look at their total assets, which now includes or also their fixed assets, which consists of buildings, equipment, and so on. So they have 160 million. Now it's not important to look at the previous one. You can look how it was in 2019, 400, 300, 300, 200. Now they ended up with 169 million. That's everything they have in total assets. So they out of this 169, they have about 50 and change in current assets, which is cash and other short-term investments and account receivable and so on. That's easy to turn it into cash if they need it to be in hand. So now you look at their total current liability. That's a very important step right here. So just look at the last one. It's 76 million. That's what they've been reporting the last quarter, and that's more than what they have in current assets. So they have 50 and change in current assets. They have 76 in current liability. That means they are going through hardship. They are under financial distress. They might not be able to satisfy their short-term debts. If they have a negative equity, they might be able to still borrow if they have enough equity, but their total liability is 113 million. So right here, we see it right here, total liability. So that consists of short-term and long-term debts. So let's see what happened with this page. Okay. So they still have some kind of equity. They have 30% of equity. They can still borrow some money from banks if they approve that. But the problem with this company is that they have a lot of net loss. Their net loss is actually it's a lot. So, and their net income, their revenues are dropping. So it's outrageous. That's the word I want to use. Their net loss is outrageous. And their revenues are declining so much. There is a huge gap of what they're making and how much is their net loss. So they're borrowing money and they are not really productive. For whatever reason we're not going to be able to know what's going on inside the company. All we have in front of us is these figures. So they have 31% of equity. They can still borrow if they find banks that will lend them money based on whatever money they're making, because banks are going to be worried about how they're gonna pay this debt. And long-term debt is actually now becomes a lot riskier than short-term debt, because long-term debt meaning that these banks, they have to question the ongoing concern if this company is going to be there enough time to be able to pay their debts. If they run out of business, of course they are stakeholders, so they have the priority to be paid their debts before anybody else. But that's a hustle. That's not a good investment for any bank that will lend this company money. So I think this company, you can turn it down. It's not a good investment. It's risky, and most likely their last quarter is going to be reported. They're going to have about 50 million loss, and their share value is going to go down. They need to restructure their debt. They need to move some of their current debt to their long-term debt. They have to go into negotiation with their creditors to see if they do that for them. And even if anything like that will happen, that's not going to help the stock price a lot. It's a bad investment. In short, saying that it's a bad investment. It's not a good investment. Even long term, it's not a good investment so far. If you wanna still dig further to see what was the loss, to see if that is administration expenses or any other things, you can look at that. But my advice: don't waste your time. This is a bad stock. Don't invest in it. It's not worth your time. So end of story. Hopefully again we'll talk about something else and new subjects and new stocks. We're gonna try to get some more stocks to study and make recommendations. and hopefully in the near future we'll be able to go live. Please subscribe, help us to get 1,000 subscribers so we can go live and look at the stocks and pick one and buy it and see how it's doing and if we can make money. Thank you for watching, and you have a blessed day.